Hello everyone, and welcome to this special webinar, 12 Great Tax Deductions. I'm going to try and do it in 12 minutes. Now what I'm talking about today are tax deductions relating to businesses, okay? I want to make that clear from the very beginning. So what I'm going to try and do is rip through them as quickly as I can. Now there is a longer version of this and I'll give you the details of all that at the end of it. So let's get started. So let's get started. So number one, what I'm going to talk about is the home office. So the main things there is if you've got a business, you're allowed to work from somewhere. Now, if you nominate your home as your work, then you can claim a lot of those costs of your home as a deduction. Now, the main rules are, though, to do that is you must produce income at home. I'll explain more about that in the longer version, but that's what you, the important thing. Once you've actually worked out that you are working from home, the easy way to do it is just to work out a percentage of the floor space used, which is exclusive for business. So you might have a house that's, 300 meters squared, and 30 meters of that is for your office, so 10%. And you just apply that percentage across all the costs of your house, which includes obviously interest on your loan, council rates, water rates, electricity, depreciation on the property and things like that. So that's the first one, because every business is allowed to have a place that they work from, and that can be actual home. Number two, one of my favorite tax tips is hire your children. Now, the important thing to understand here is there's a Child Employment Act in every state. In New South Wales under the Department of Fair Trading, and that Child Employment Act covers all the areas of actually employing people under the age of 18. Now it talks about how much pay rates, when you're allowed to employ them, what days are allowed to work, all that sort of stuff. However, if you have your own business and you employ your own children, those people do not need to comply with the Child Employment Act. So basically you can do whatever you want. You can employ your children if they're 10 years old even. So that's the really, really important thing, that you don't have to comply with that. Now, a couple of really important things though is make sure you do actually pay them. That's really important. You don't have to pay them super because they're under the age of 18, which is really good. So just remember, that's a really good one. Hire your children, and that's a big deduction because what you're trying to do is obviously pay your children money, which is in the tax-free threshold part of it. Moving along to number three, the $20,000 asset write-off. A lot of people understand this one, so I won't spend too much time on it. Basically, you can deduct up to $20,000. So if something costs less than $20,000, you can claim it as a deduction in the year that you purchased it. Normally, if you went and bought like a piece of equipment, some computers or a car up to $20,000, you had to depreciate it over 2, 3, 4, 5 years, whatever. Now, you just write off in that year. So that's really important. What you also need to understand is not limited to $20,000. You can have actually 5 items worth 20 or just under $20,000 each. So that's like $100,000. So it's not limited to $20,000 or one particular item. Remember that one. You need to have physically paid for it or at least financed it before the end of the year. Number 4, plan your holidays around getting a tax deduction. How good's that? Some really important things though, and really talk to me about these ones, but the main thing is you've got to plan. Don't just arrive at a Hawaii or somewhere like that and try and justify it as a business. Look what's on there. How can that relate to your business? How can that help you earn income? All those sorts of things. But the main thing is to plan first. For example, if there is a conference in Hawaii, make sure you buy the tickets to the conference before you buy all the airline tickets for you and your family. Okay, so then obviously there's some different things that you can claim, your cost of the airfare and all those things, not your family's, but that's the main thing. But it has to relate to your current income, not any new business that you're thinking about doing. But the most important thing is to definitely plan in advance, and therefore you can get a nice deduction, tax deduction for your next holidays. Okay, number 5, log your kilometres. This one's boring, but I can't believe how many people, they know if they've got a car and they're claiming a percentage either through FBT or their normal work-related deductions, and they don't keep a logbook. Please, people, just keep a logbook. It's not that hard. Every time you drive your car for business purposes, write it down. It doesn't need to be on an official logbook or anything like that, just a bit of paper. But keep the records, which is the date, the purpose of the trip, and how many kilometres were driven. That's all you need to do. Nothing harder than that. So when you're doing this, think to yourself, oh, how I love to save money by spending 30 seconds to record one line of information that will reduce my tax bill. How about that? Just do it, people. It saves you in the long run. Number 6, this is another good one, is superannuation is a tax deduction. Depending on what your tax rate is, if it's a company tax rate at 30%, you've got to remember that super is taxed in the superannuation fund at 15%. So as long as the tax you're saving is better than that, you're making money. And the great thing about super, it's not actually going anywhere. It's not like you've spent the money and it's gone, like spending money on your accounting fees. This is just going out of one area of your wealth to another area of your wealth, and you're getting a tax deduction for it. Have to do that one. Okay, a couple of technical ones here. Number 7, converting bad debt into good debt. Now, what you've got to try and think about here is that if you've got a business, particularly a company, it really only works if you have a company. Now, back in 2002, the courts allowed a business to borrow money to repay debt. Now, most people think, oh, a debt, that's with the tax office or with a bank or something like that. But a debt could also be you, the owner of the business. So most people get that they have to put money in, particularly in the very beginning, into their company to get it going. Might be a few $1,000s, might be hundreds of thousands of dollars. But you are now the bank, or you are owed money. Now, if you go and convert that and borrow some money, or because early on, the banks won't lend you, your company, any money at all. But after a few years, they probably will. So what you're trying to do then is to repay yourself, because that's the whole purpose of running a business. Now, if you do go and borrow money to do that, the interest on that is then tax deductible. So have a think about how you're going to do that. But if you have actually getting money back out of your business, that's probably the best way to do it. And obviously when you get that money back, you pay off non-tax deductible debt like credit cards and home loans and things like that. So you're sort of converting your non-deductible debt into tax deductible debt by using your company. So a little bit technical, that one, but talk to me about that one if you really need to. Another one, which is sort of similar, but it's different. And this is about claiming the interest on your current home loan as a tax deduction. Same thing's got to work though. You need to have your company where you've actually put money into it. So the company owes you money. What you need to do in this situation, rather than going the company actually borrowing money, is that you just do a formal document where you document that the company owes you money. And there's going to be an interest rate paid on that. Now, what you understand, of course, is that interest that you earn then is income to you. But it's a deduction for the company. So really you haven't saved anything at this point. So your company will receive a tax deduction for the interest paid, which is great, but you personally then have to pay tax on that income. Now, some people just leave it at that because all of a sudden it's why you're getting money out of the company and you don't have any workers' comp or payroll tax or superannuation or PAYG to worry about because it's interest. But this is where you get clever, is that in your home, say you got a home loan, now what you need to do is to show that this, you can split your home loan, say you're owed $100,000 from the company. If you went and split your home loan into two parts and $100,000 of that was separated, you could then show, well, that's the money that I lent my company, and then you get a personal deduction for it. I know it's not it might sound a little bit strange, but I'll show you a little bit more if you want to talk about it. But the important thing is to have a split home loan. You can't just sort of say, well, here's one loan, I'm going to call part of it deductible and part of it non-deductible. You can't mix the debt, okay? Really, really good deduction, that one. Moving along, because I've only got 12 minutes to do this. Number 9, if you are selling your business, you are up for capital gains. It's like selling a house or shares or anything like that. Don't forget that. However, there's a heap of options when you go and talk to someone like myself who will help you minimize your tax and in a lot of cases actually make it zero, okay? So if you're selling a business, talk to someone well before you actually get to that point. Number 10, getting the right business structure. This should be number 1. Should have been number 1 because I see too many people who are operating as a sole trader, company, family trust, or a partnership, and it's wrong. It's wrong for their structure and the way they're trying to do things because all these things have their place. You just need to make sure that it suits you. Too many people come in to me and go, Derek, I need a family trust. And I go, why do you need a family trust? Well, my brother's got one. Not good enough. It's got to suit you. So you get it right and you can save a heap of money with your tax, particularly if you can get a family trust structure in there somewhere. Number 11, I'm running out of time, but number 11 is using companies with existing losses. This is a no-brainer, this one. I see too many people come to me and say, Derek, I've got this old company. Remember that business I used to have? I'm sick of paying the $250 worth of ASIC fees every year. Can you wind it up for me? Oh, I go, no, I'm not going to. And they go, oh, come on. I said, because it's got losses in it. Losses can now be carried forward forever, as long as you remain the shareholder. That's important. Otherwise, I'd be buying off you, and I'd have a shelf full of companies with losses. You got to keep them, but who knows what you'll do one day? You may resurrect your entrepreneurial desire and do something else. Or there could be some opportunities from family trust distributions and stuff like that. But don't get rid of companies when they've got losses in them. They're fantastic things. So companies can carry forward losses forever. If you wind them or deregister them, they're lost. Don't do that. Number 12, getting to the end of it, defer income. All we're doing here is throwing the problem into next year. But next year it could be a better place there. So if you're a small business and you're operating on a cash method, well, obviously don't bank the money until the 1st of July. Don't visit. Yeah, it's pretty easy on this one. And the other thing too, if you're operating on a non-cash method or an accruals method, just do the invoicing the 1st of July. It's pretty simple stuff. Boring, easy one at the end. So they're my 12 favorite tax deductions for a business. Hope you like them. Please stay connected. Check out my website. Now, this is where I told you about the long version of this. Go to www.12.com.au, go to the webinar area. I think it's even on the front page. Scroll down and there's the 12 favorite business tax deductions there. A lot more detail, but I thought I'd do a 12-minute one to get everyone excited about it. End of the financial year. Hope you enjoyed it, and goodbye for now.